Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Micron Technology.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total cost before signing anything.
So, what if I told you that a completely boring legacy hardware company, a company that literally just prints physical silicon chips, just posted profit margins that rivaled, high-end agile software startup.
Right, which is historically just unheard of in this space.
Exactly. It's wild. We are looking at a 200% revenue surge that is fundamentally breaking basically every traditional rule on Wall Street right now.
Yeah, it really is. Because for decades, the memory chip business was essentially the farming sector of the tech world,
Yeah, a pure commodity.
Exactly. It was a purely cyclical commodity. You had your boom years when prices were high, and then your bust years when supply just flooded the market.
Right. And as an investor, you are entirely at the mercy of unpredictable global demand.
Yeah.
Just totally along for the ride.
Completely. But looking at the data sitting on the desk today, we aren't just looking at a good quarter here. We are witnessing a complete structural transformation of a business.
All right, let's move into the wealth building context. Because when we talk about building long-term wealth, the instinct for many of you listening is practically to chase the flashy consumer-facing software, right?
Oh, always. Everyone wants the next big app.
Right. But history tells us that the real generational wealth is often built in the infrastructure layer. The picks and shovels, as they say.
Exactly. If you look at the hundreds of billions of dollars being spent by the massive hyperscalers.
You mean the giants building out these colossal AI data centers?
Right, exactly. You realize they are practically forced to spend that capital on very specific physical components. And the most critical component driving this current AI revolution is a technology called high bandwidth memory, or HBM for short.
Okay, let's actually define that for the listener, because the financial industry loves throwing around acronyms without actually explaining what they do.
Too true.
So if standard computer memory is like a single lane dirt road connecting a data warehouse to the processor, what exactly is high bandwidth memory?
Well, in that analogy, high bandwidth memory is like a 32-lane magnetic levitation highway.
Wow, okay.
Yeah. To put it simply, artificial intelligence models require moving literal mountains of data back and forth at lightning speed. You physically cannot train a modern AI model without these highly advanced memory chips acting as the bridge between the core processor and the data storage.
So it's not optional?
Not at all. It isn't just a preference for the tech giants. It is a hard physical constraint of the computing architecture. If they want to build the AI, they have to buy the HBM. Full stop.
But, my natural skepticism kicks in right there. The tech sector evolves at a breakneck pace. Are we absolutely sure this specific highway won't break, or worse, become entirely obsolete in 2 years as new architectures come out?
It's a completely fair question, but the physics of computing currently dictate that as processors get faster, the memory bottleneck only becomes more severe.
So that the problem actually gets worse.
Exactly. This isn't a temporary trend. This is a massive, multi-year infrastructure build-out. For long-term portfolio growth, the HBM supercycle gives you, the investor, a direct backdoor way to profit from the massive capital expenditures of these hyperscalers.
So you don't have to pick the winning AI software.
Right. You aren't guessing which AI software will win the market. You are essentially taxing the entire ecosystem's growth. Now let's look at the fundamentals.
Yeah, because a great narrative doesn't always equal a great business, right? We need to see if that toll road is actually collecting money. And looking at these numbers, wow, the financial metrics are genuinely staggering.
They're off the charts.
In their fiscal second quarter of 2026, revenue hit $23.86 billion.
Which is just a massive number.
Again, that is a roughly 200% surge compared to the exact same quarter last year.
And we have to unpack exactly where that surge is coming from, too. It's driven by unprecedented pricing power. I mean, in a single 3-month window, the average selling price for DRAM.
And just to clarify, DRAM is the short-term working memory for computers, right?
Exactly. So the price for DRAM rose by 65%. And NAND prices, which handle long-term data storage, rose by 75%.
Let's pause right there, because for anyone listening, that is the metric that should make your jaw drop. For the average selling price of a physical hardware component to skyrocket 65% in 3 months, I mean, that implies a level of absolute desperation from buyers.
It really does. And that desperation is what creates the true showstopper metric here, which is the margins.
Right.
Just a few years ago, during the cyclical troughs of the memory market, we were looking at negative gross margins. Like, they were actively losing money on every chip they made.
Ouch.
Yeah. But in this latest quarter, their gross margin exploded to 74.4%.
That's insane for hardware.
And it gets better. Management is officially guiding for that to hit approximately 81% in the third quarter. Oh, and their operating margin is sitting at 68%.
Which basically means we are seeing massive operational leverage.
Yeah.
Once their fixed costs for the factories are, covered, almost every additional dollar of revenue just drops straight to the bottom line.
Precisely. And that leverage is why earnings per share came in at $12.20.
$12.20.
Yeah, $12.20. That is an 8-fold increase year over year. And guidance is pointing to $18.90 for Q3. And if you look out to the broader horizon, analysts at UBS are forecasting that EPS could reach an incredible $135 by calendar 2027.
I mean, those growth metrics are undeniably massive, but, as someone who always looks for the trapdoor, what truly validates this growth for me is the balance sheet.
It's solid.
Because explosive growth in hardware usually requires explosive, dangerous borrowing to build new factories. But their debt-to-equity ratio is sitting at a pristine 0.13.
Which is remarkably low.
It's virtually non-existent. I mean, compared to the S&P median, which sits around 21%, they are generating a 52.7% operating cash flow margin.
That's a ton of cash.
Yeah. What that means for you as an investor is that this entire $20 billion capital expenditure plan they have laid out for 2026 to expand their advanced capacity, it is entirely self-funded.
Right. They aren't borrowing a dime for it.
Yeah, exactly. They aren't leveraging the company to the brink to chase this AI dragon. They are even paying a 15-cent dividend, which represents a minuscule 2.83% payout ratio. It is just an absolute fortress of a balance sheet.
And that fortress is protected by an incredibly wide economic moat, too. They operate in what is effectively a global oligopoly.
Right.
Between this company, SK Hynix, and Samsung, you are looking at roughly 95% control of the global HBM market. The barriers to entry here are basically insurmountable for any new startup.
I'd imagine.
Yeah. The capital intensity is astronomical, the manufacturing processes require microscopic precision, and honestly, the qualification processes for the tech giants take 6 to 12 months just to get approved as a vendor.
And specifically, their newest HBM3E technology seems to be leading the pack, right? The data shows it delivers 1.2 terabytes per second of bandwidth while consuming 30% less power than their competitors' chips.
That power metric is huge.
Oh, it's everything. In a data center, power consumption is literally the biggest bottleneck. We are hitting the physical limits of local electrical grids. That 30% energy efficiency makes them an absolutely indispensable supplier. That brings us to the catalyst timeline.
Yeah, because we have established a financial fortress and the product superiority, but as investors, we really need to identify the specific future events that will trigger the market to actually push the valuation higher.
Right. And the immediate hurdle is the Q3 fiscal 2026 earnings report, which is scheduled for late June. We mentioned management's guidance earlier, but let's put it into perspective. They are guiding for $33.5 billion in revenue and $19.15 in earnings per share for a single quarter.
It's mind-blowing.
That quarterly revenue guide beats their entire total revenue for fiscal year 2025.
Yeah, it is almost hard to comprehend a business accelerating that violently.
Seriously.
Yeah.
And beyond those earnings, you also have the massive $200 billion U.S. manufacturing expansion underway across Idaho and New York, which is heavily backed by federal funding through the CHIPS Act.
Right, and those are the tangible, scheduled catalysts that the market already knows about. But the speculative catalyst, the one that could completely rewrite the valuation model, is the current rumor regarding NVIDIA's next-generation HBM4 platforms, known as the Rubin architecture.
Okay, I've heard about this.
Yeah, right now this company is structurally locked out of those specific systems. That supply chain is currently aligned with their competitors.
And here's where I have to, urge extreme caution for the listener. Relying on an unconfirmed Wall Street rumor for your investment thesis is a very dangerous game.
Absolutely.
Furthermore, when management guides for a quarter that beats an entire previous year, the stock is effectively priced for absolute perfection. A slight miss on those Q3 numbers, or, a delay in that factory expansion, could be punished severely by the market.
The caution is entirely warranted, Alex. I mean, the caution makes perfect sense. But you have to weigh that against the asymmetric upside of the rumor.
Fair point.
If they do get formally qualified for those Rubin platforms, the narrative completely shifts. They immediately transition from being a secondary supplier in that specific highly lucrative ecosystem to a core infrastructure player.
Which is a massive jump.
Exactly. And the broader market hasn't fully priced in that potential qualification because it isn't official yet. If the announcement drops, the valuation re-rating goes into overdrive. Now let's pivot to the chart.
Because the technicals are reflecting exactly this fundamental explosion we've been discussing, and frankly, they look incredibly extended. I mean, the stock went up 53% in April alone.
Yeah, that was a wild month.
And over the past 12 months, if you look at the chart, it is up over 600%. It's currently trading just shy of its 52-week high of $545.91.
Right, and what we are seeing is a sustained golden cross in what technical analysts call a phase 2 advance.
Let's translate that for the audience, actually. A golden cross happens when a short-term moving average crosses above a long-term moving average. Specifically, the 50-day average crossing the 200-day average.
Right.
It signals that short-term momentum is completely overwhelming the historical trend. Right now, the 50-day moving average is at $414.69, which is sitting miles above the 200-day average of $266.83.
Way above it.
Yeah, with support established way down at $403. But I have to play devil's advocate here because this is what every retail investor is thinking. Up 600% in a single year. Doesn't that heavily imply that you, the listener, have already missed the boat? Or are we just providing exit liquidity for the smart money?
I get that. It absolutely looks parabolic on a surface level, which is why we have to dig into the underlying momentum indicators to see if the trend is exhausting itself.
Okay, let's hear it.
Let's look at the 14-day RSI, or Relative Strength Index. Think of the RSI like a stock speedometer running from 0 to 100. Right now it's sitting at 68.91.
Which is pretty high.
Yes, we are driving fast. We are nearing that overbought red line of 70. But crucially, there is no bearish divergence. The engine isn't stalling out while the car coasts, The fundamental momentum is perfectly matching the price action.
And the MACD indicator corroborates that, right?
Exactly. MACD stands for Moving Average Convergence Divergence. I know it sounds like pure jargon, but it basically measures the pulse of the stock's trend by comparing two different moving averages.
Got it.
Currently, the MACD is at 23.04, sitting comfortably above its signal line of 14.89, in plain English. That confirms the upward momentum is still actively building.
Okay, so the technical indicators aren't flashing a reversal, but technicals alone don't move markets. Capital does.
Which is why you have to look at the institutional flow. This isn't just retail day traders chasing a chart on Reddit. Massive institutional players like Vanguard and State Street have actively added to their positions at these elevated levels.
That's a good sign.
We are also tracking unusually large bullish options activity. The big money is accumulating shares and positioning for further upside, which tells us this 600% run actually has deep foundational support.
So what does market sentiment look like?
If you zoom out to the broader market and institutional perception, the headlines are overwhelmingly bullish. I mean, major financial news outlets are actively comparing this margin trajectory directly to the historic margin expansion we witnessed with NVIDIA over the last 2 years.
That's high praise.
Oh, absolutely. Analysts at Mizuho recently put out a research note stating point blank that they could not be more bullish on DRAM.
And the analyst price targets certainly reflect that euphoria. We are seeing massive upward revisions across the board. Melius Research initiated coverage with a street-high price target of $700.
$700. Just think about that.
Yeah. Deutsche Bank And Stiefel lifted their targets to $550, UBS jumped to $535, and RBC raised to $525.
Everyone's getting on board.
And as you mentioned with the flow data, institutional ownership is massive, sitting at 80.84%, with major players like D.A. Davidson and Invesco adding heavy positions in recent quarters. But I have to push back again here.
Go for it.
When you have 80% of the stock already owned by institutions and analysts falling over each other to raise targets, who's actually left to buy? Hasn't the trade become incredibly crowded?
It is a crowded trade, but the sentiment picture isn't entirely flawless. If you want to find the crack in the armor, we have to address the insider activity.
Right, and this is a classic red flag that usually sends cautious investors running for the hills. We've seen Executive Vice President April S. Arnzen sell 40,000 shares, and Executive Vice President Sumit Sadana sell 24,000 shares recently. When the executives inside the company, the people who see the real-time data, are dumping shares near 52-week highs, the natural assumption is that they believe the valuation has peaked.
Context is absolutely vital here, though, and this is where understanding market mechanics saves you from panicking. These specific transactions were executed under Rule 10b5-1 prearranged trading plans.
Meaning they didn't just wake up yesterday, look at the stock price, and decide to hit the sell button.
Correct. A Rule 10b5-1 plan is a legal mechanism set up months, sometimes years, in advance. Executives use them to schedule the sale of specific amounts of stock at predetermined times or price levels, specifically to shield themselves from insider trading accusations.
Because it's on autopilot.
Exactly. Because these sales are pre-scheduled on autopilot, it severely mutes any bearish signal you might normally interpret. It is routine portfolio diversification for an executive, not a panic exit before a crash. Now let's talk about the risks.
Yeah, and there are severe, realistic threats to this bullish thesis that we cannot ignore if we're being objective. The first major threat is technological disruption. Google recently announced a new proprietary technology called TurboQuant, which allegedly reduces the memory needs for AI inference workloads by 6 times.
6 times is massive.
It is. If the broader tech market adopts a software solution that requires 6 times less physical memory, doesn't that structurally bend the entire demand curve downward?
It is a highly valid threat, but to understand why it doesn't break the thesis, we have to thoroughly explain the difference between AI inference and AI training.
Okay, lay it out.
Inference is when you ask an AI a question and it gives you an answer. It takes relatively less computing power. TurboQuant is targeting that specific efficiency.
Got it.
However, AI training, which is the process of feeding the AI the entire internet so it learns how to think in the first place, is entirely different. Training workloads are where the heaviest, absolute, non-negotiable demand for memory exists.
And that's not slowing down.
Not at all. The major hyperscalers have over $700 billion committed to capital expenditures, and that capital is being deployed into massive training infrastructure, which requires high bandwidth memory regardless of these emerging inference efficiencies.
Okay, so the demand for training remains robust. But even if demand holds, I have to bring up the ghost of memory cycles past.
Oh boy, here we go.
I mean, historically, every single time this specific industry has experienced a massive demand shock, it has resulted in a devastating supply glut.
True.
Right now, we have this company spending over $25 billion on capital expenditures to build new factories. And Samsung is spending over $73 billion to do the same.
Which is a huge expansion.
The market has a very real historical fear that the second quarter of 2026 was the quote-unquote priced-in peak. The fear is that this massive capex race will inevitably flood the market with millions of excess chips, crushing the average selling prices and completely wiping out those beautiful 80% margins overnight.
That is the traditional cyclical bear case. And if you look at the last 20 years of the semiconductor industry, it has historically been correct.
Right.
But here's the checkmate fact that fundamentally alters the risk profile today. Their entire high bandwidth memory supply is completely sold out for calendar 2026.
Wait, entirely sold out for the whole year?
100% of their capacity is spoken for.
Wow.
And we aren't talking about verbal handshake agreements that can be backed out of if the economy slows down. These are locked-in, ironclad contracts with massive prepayments from the hyperscalers already sitting on the balance sheet.
So they already have the cash.
Yep. This practically eliminates near-term earnings volatility. The supply glut fear simply cannot materialize in the near term when the entire next year of production is already bought and paid for in cash.
So with everything on the table, what's the final verdict?
Well, based on our analysis, the stock earns a highly bullish score of 8 out of 10.
8 out of 10. And, when you synthesize all the moving parts we just talked about, the pricing power, the debt-free balance sheet, the sold-out capacity, the core thesis is that the broader market is fundamentally mispricing the structural transition of this company.
Precisely.
Because of their hyper-growth trajectory and the massive earnings power expected by 2027 and 2028, the stock is currently trading at a forward PE ratio of just 4.91.
That's incredibly cheap.
Right. If you pay just $4.91 for every dollar of expected earnings, you are pricing this like a dying commodity business. If the market valued this like a true AI infrastructure bottleneck,
Right.
that multiple would be significantly higher.
Exactly. The market is still treating it with the cyclical skepticism of the past rather than recognizing it as the indispensable AI toll road of the future.
So it's a longer play.
Definitely. This is not a short-term swing trade. The investment horizon here is a multi-year hold spanning 1 to 3 years. That duration allows you to fully capture the ongoing capacity expansion and the massive earnings per share re-rating that analysts are projecting as those prepayments turn into realized revenue. The fundamental shift is real, the technology is required, and the capacity is locked in.
Need emergency cash. MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.